at Trade. Naeem, always such a pleasure to have you with us today. Let's start off with the optimism and the good news that we've received so far, especially coming out of the US. Although ADP numbers disappointed on Wednesday, the US non-farm payroll figures really impressing the market today with that print of 223,000 jobs on the market. Was this expected, and does it make sense, especially given that the US is struggling at the moment in order to recover?
All right, so
thank you so much for having me, first of all. I think there are a few key elements and takeaways that we wanted to deliver for the markets. Number one, we said previously that do not just focus on the Q1, and the Q1 has no reflection for the rest of the year. We've done about 30 years of study on Q1 GDP, and then we compared that to the rest of the quarters, and there was absolutely no correlations. For example, in 2010, the GDP for the first few quarters till 2014 was only minus 0.23%, and whereas for the rest of the year it was a lot more higher. So they was like comparing to different economies, but regardless, the point is that the first quarter GDP does not represent what is going to take place for the next year. So now, given that we have another very brownie data out of the US today, so we think that is a very positive element. However, there is a structural change in American industry, and this is very important to pay attention to. If we look at the amount of manufacturing jobs US have actually created, now these are the jobs which have been brought back from different parts of the world, and the companies have started manufacturing and putting a stamp made in the US. These are those jobs which are back in the US. The number has increased to 60,000 so far this year. And the amount of jobs which have been gone to offshore to different parts of the world, that's only 50,000. That number, if you compare that to the previous years, was nearly 150,000. So it's a massive change in different structure, how the US economy is going to progress going into the next few years or the quarter. So we do think that the US economy is on a robust foot ground, and then it has a potential to grow in a steady way. But then the question comes up, okay, what is going to happen with the rate hike? Is Janet Yellen, is she going to raise the interest rates in April, well, in June, or whether it's going to be in September? Regardless, we don't focus on when exactly the rate hike is going to be, although we think that it could very well be in September. I think the most important and significant element to pay attention is the liquidity issue. And we have a flash of this one, which is brought into a spotlight recently in the bonds. There's not enough liquidity in the market if Fed is starting to raise rates very sharply, or if they take aggressive approach increasing interest rates. They have to increase the interest rates regardless of how or when they are going to take it, but it's the approach how aggressive they are going to take, because most of the funds, they do not have a sufficient liquidity with them. Why don't they have a sufficient liquidity with them? The reason is because the United States or the Federal Reserve have done 3 rounds of quantitative easing, and each single round has sucked more money out of the system, and these hedge funds or these bigger funds, they do not have enough money. So if a panic sell-off starts in the market, there's no one to support the market. That's going to create even a massive blow in the economy.
Naeem, if we could turn our attention now onto the overall Eurozone, maybe if we get your insights on the investor certainty that has been maintained on the back of the UK elections, as well as Greece, still the biggest headache, I take it, for the overall Eurozone region.
Yes, absolutely. It is still the biggest elephant in the room, and that's the major concern for most of investors. When we are speaking with our investors, the main question is, okay, is Greece is really small enough, and is one of the reasons that this contingency is not taking place in other. So let's look at, and the 2 reasons that generally they will say, okay, is because it is quite small and they can easily be contained. Now, let's look back. I mean, it's a very well-known example of what happened back in during the financial crisis with Bear Stearns, which was a very small institute to start with, but the crisis literally went all over the place. But my major concern when it comes to Greece is we do not actually know the size of the mess Greece is really. Yes, the EU officials are saying that, okay, they are coming as a very united front, that we are going to handle this one regardless if Greece can be kicked out of the Eurozone. But here is a very important affair. The two biggest economies within the Eurozone, Germany and France, they are completely in a different directions. Now, what do I mean by that? They do not abide by the rules which are set by the EU officials. Germany, they have a surplus of nearly 7.9% for this year, and then for the next year it would be 7.7%. France, on the other hand, has a deficit. Now, both these surpluses and the deficits are well beyond the limits which are allowed for them. And if we talk about structural reform, in France, it still hasn't taken place in a way that we wanted to, or the ECB wanted to have. So although they are saying, okay, it can very well be contained and there's enough firewall, I do not buy that argument at all. I think if Greece leaves the Eurozone, we have a much bigger problem. Now, going back to your first question about the UK, now all that uncertainty is over with, okay, who is going to handle the government? Okay, we do know this, Mr. Cameron. So fiscal and monetary policies stay in place, so which is a much better sign. And this is what fanning the rally in sterling all across the 10 baskets. It was quite interesting to see, and I actually tweeted on my account this morning that we had a head and shoulder formed on sterling dollar, but in about 2 hours, the neckline was broken, and that gain was literally wiped off, and now it's kind of consolidating from there.
Naeem, we're going to have to leave it there. Thank you so much for your time today and the analysis of the global market space. That was Naeem Aslam, Chief Market Analyst of Advert Trade, joining us from